And we're on.
Good evening, everybody. This is Chinchilla Picking Podcast. We always hope to be entertaining, educational, and uplifting because we want everyone to make money. It is June the 10th, 2021. Another Thursday night. I hear the cicadas outside my house. They are loud. They are everywhere. They are all over the place. I wish I could buy the stock on cicadas, but you can't right now. So
I cut my grass the other day and it made them really angry. One landed on my nose. One landed on my nose. They were suicide diving into my face. It was, they're annoying. They're kind of cute though.
Well, I mean, don't tell that to the people who are putting them on pizza.
Ugh, gross.
Frying them with eggs.
Yeah, you know,
just peel off the wings and legs is what I hear.
They're good. They're good to fish carp with.
Are they?
Yeah. Take them out here to Houston Woods or Brookville Lake and go to town. You'll catch some fish.
Nice. If you guys don't know, if you're one of our non-Cincinnati area listeners, we are in Cincinnati, Ohio, and that's what we're talking about. Places around here. All right, guys, rules. Here's the rules. Brandon and I meet up about 5-10 minutes before we start the show, and we tell the other person what we're going to talk about. We don't discuss it until the time of the show. And we do have a few things that we brought up that we both wanted to really go back and forth on that we found out we disagree on. So, Brandon, since you have the most that I disagree with, let's let you go first, right? So let's get that out of the way, huh?
Well, you said that once on our past episodes that if you're going to eat crow, you might as well do it right away. And I made a bad call on our Instagram on John Deere, ticker DE. And I got in on this. I thought we were getting a reversal of momentum here. And I was playing it off the MACD and the RSI. And I made the mistake. I don't think that I should have been playing this after a potential bear flag was forming. And then also, if you look at the MACD, this thing was too choppy. I bought in a couple of days ago already when the MACD was starting to level out and not cross the signal line. And really what I should have done is I should have looked at this. I should have pulled up the daily chart. And if you pull up the daily chart, look at the MACD, you can see this stock is not very predictable on the MACD. It is too choppy, and I should have stayed away from it. We all make mistakes, but, you know, here on the Chinchilla Picking Podcast, you can learn from ours. So
hopefully we all take something from that, you know.
Yeah.
Pay attention to your lines, and if you see that bear flag forming, you know, stay away. You don't want to push the risk. I feel like, from what you just told me, we're pushing the risk, hoping to go ahead and get that return, even though you saw the indicators that maybe I shouldn't do this.
Yes, I should have. My thing was I cashed out on a lot last week, and I did pretty well, and I was sitting on a lot of money, and I made the mistake of feeling like it was burning my pocket, and I started looking for things to buy. This week I couldn't find any. To me, I see hardly any value in other than what I'm already in. And I tried to force a trade, and I shouldn't have done it. So, learning the lessons and move on.
Yeah, that's exactly that whole when people just cashed out of some trades, that mentality of I got to get back into something else. Mm-hmm. That's what kills you. That's what really drains your account, your wallet. There, you don't have to get back into something else. You have to wait for the next opportunity. Is what you have to do.
Yep, exactly. So, moving on here, though, you know, last week on this show, Bob from the Money Vikings was on, and he mentioned that he was afraid that the hedge funds were actually starting to take over Wall Street bets and use it for their own gain. And then right after that, this week, Wendy's hits the Wall Street bets, got high institutional ownership. Nelson Peltz is the chairman of Wendy's. He also owns the Trian Fund, which is a large hedge fund. That hedge fund owns 12% of Wendy's. Nelson himself personally owns 7%. There is less than 4% short float on Wendy's. This was not a short target stock. There was no reason for that to happen at all. So, I mean, I think to me, that might just be proving Bob's point. there may be. You're not sticking to the hedge funds by driving Wendy's up. They made millions of dollars.
By now, do you not believe that the institutions, the financial institutions, have people inside these forums leading the discussion in the way they want them to lead?
Mm-hmm.
Come on.
Absolutely.
Come on.
Other than that, in the news, Jeff Bezos has announced that he's going to be the first ex-CEO to probably die in outer space next month.
Yeah, it may happen next month, but like...
no, he's actually, it's scheduled for July. It's scheduled for July for him to go.
His Blue Origins company to send them up?
Yep. I don't think he's going to die. I was just kidding.
Talking about later on in life when he goes on a big long journey or something.
Nope. He's going next month to test it.
The one he's going on next month.
Yep. I think it was July 7th.
Wow.
Yeah. He's not going to be the one flying it. He's got a crew. I mean, he may look like Picard, but he's not Picard. He's a passenger.
Right. I just feel that with Blue Origin, SpaceX, Virgin Galactic, all this commercial space exploration that's going on, one of these CEOs is going to want to spend their last days flying off to Mars or something, and they're going to just do it because they can, because their companies have the ability to produce that.
A lot of these guys by nature are very high adrenaline and looking for adventures, and that's why they did so well. They don't mind taking risks. So, I mean, look at Richard Branson. The guy he's always doing something crazy, skydiving or flying or whatever.
He's going up in the first tourist flight of his Virgin Galactic.
Is he?
That's scheduled to happen end of this year, isn't it? Yeah, end of this year.
Nice.
Then you and I can go ahead and book some flights and we go into space, Brandon.
No thanks.
We could do the podcast direct from space.
I'm going to Mars. I'm taking this podcast with me to Mars. To Mars, baby. To the moon.
All right, go ahead. Let's keep going.
All right. Then the G7 leadership, they had a meeting last week, and I think it was over the weekend. They agreed that they're going to work on a 15% global minimum tax, and they're specifically targeting the tax shelters like at the Cayman Islands, British Isles, and so forth. Chinese stocks kind of took a hit on this because all Chinese stocks that are listed in the New York Stock Exchange, they are actually holding companies that are in the Cayman Islands. And it's actually not a tax shelter for them. That's not the reason why they're doing it. The reason why they have it set up that way is because China has a law that foreigners cannot directly invest in their companies. So what the Chinese companies do is they set up these holding companies in the Cayman Islands, promise their profits to these holding companies, and then they list the holding companies on the New York Stock Exchange and even on the Hong Kong Stock Exchange. So that's the reason why they have their listings in the Cayman Islands. It's not a tax issue. And in fact, they're still paying taxes to the Chinese government the way that they're supposed to. The interesting thing is I don't think that the Cayman Islands government has actually commented on the G7 agreement, but their financial sort of central authority did, and one of the spokespersons for that said, we're not going to tax people on top of what they're already being taxed from their home countries. They actually assist the home countries of the companies in collecting taxes in the way that they're supposed to by law. And but a lot of people I think were concerned too that these people are listed in the Cayman Islands. Is the Cayman Islands going to tax them on top of their home countries? And they said they're not going to do that. So the hit on Chinese companies I think was a little bit overblown.
I think the whole thing with the Cayman Islands is overblown, and I don't like what the G7 is trying to do. I personally the Cayman Islands are their own sovereign nation. They have a right to not tax or be a quote-unquote tax shelter to whoever they choose to. That's their country. That's their right to do that as their own country. They are not part of the United States. We cannot tell them what to do with their financial institutions. Guys, leave them alone. If that's what they want to be, that's fine. And if American individuals find a way to legally move money over there and not pay tax, and they didn't do it illegally, but they legally moved the money over to that country's, let it grow tax free. Great for them.
Yeah. Some people
see a problem with that.
Some people will say that's stealing, when in reality it's just keeping more of the money you earned. But
that's not stealing. There's no way.
No.
You can't define. If you define stealing, that's not stealing, because stealing is taking something that's not yours. All of that is theirs. They pay taxes on that. Say they had $1 million, right? Mm-hmm. So they've already paid tax on this $1 million. They're going to move that $1 million now to another country, and in that other country, it's going to grow and grow and grow. But they're not going to pay taxes on it because that money is in another country.
Right.
That's how it works. Like, they pay tax on the principal, and the interest they earned in another country. It's like if you go work in some other country and you pay taxes on your earnings in that country, you shouldn't have to come back and pay taxes again on it in the United States.
Right, exactly. Now, some people are concerned and have been concerned for a long time about the setup of these Chinese companies, where their holding companies are what you're buying into. And the reason being is that since you can't buy direct shares into this company, then there's not going to be a possibility of any activist investors from the outside, because they're not going to be able to make that, have that kind of influence in a company if they can't buy direct shares into it. However, back in 2011, Yahoo was a huge investor in Alibaba, and Alibaba was spinning off Alipay, and Yahoo, it didn't make them happy at all. Jack Ma didn't have to do this. Yahoo was investing in the holding company just like every other foreigner's doing. They were not direct owners of Alibaba, but Jack Ma still flew himself to the United States and negotiated a deal with Yahoo. So for Alibaba, to me, that was a good sign. I don't see any issues with the way they're set up at all. I think that as long as you're buying a reputable company, you're still fine. And I still think China, for the most part, the Chinese stocks are undervalued.
Yeah, you've been pushing them 10 cents.
I'm happy about it.
They are undervalued. There's a lot of growth there. I think China is positioned itself well to be strong in the financial future. I think China has really grown their ability to negotiate with bigger countries such as the Soviet Union, the United States, and Europe as a whole. I think the Chinese government as a whole has grown its ability to be a bigger influence via the number of carriers it has built over the past few years, and having that influence there to say, we're going to buy your bonds at this price because we said so. And that has an effect all around the world.
Now, Charlie Munger bought Tencent for one of his funds. And then went on to make the comment that the best companies in the world today are in China. I tend to agree with him right now.
I like Charlie Munger. I really like Charlie Munger.
And I wanted to ask you in particular, what's your benchmark for your investing? Like, what do you look at the end of the year, and what tells you if you were successful or not?
The benchmark that I put myself up against is the goal I set for myself. Can I improve my portfolio that I'm actively trading in trading accounts, right? Not investment accounts. I have my accounts separated to where the account with this company is for investing and this account's for trading, right? Mm-hmm. Can I grow my whole trading account at 5% a week? That's my goal. It's simple as that. I set that goal for myself. I continue to set that goal for myself. And as long as I am positive every single week, week in, week out, my goal is 5%. If I only hit 2 or 3%, I'm actually happy with that, but I prefer 5%. And at the end of the year, if I have at least I would say, over doubled my account at least once, then I would be satisfied with my trading account. But Brandon, again, I've been doing this for such a long time that you always try to throw these questions at me and try to catch me, and I always
I'm not trying to catch you.
And all these stocks. I know, but like I've been doing this for such a long time that I can easily guarantee myself to over double my trading account year in, year out.
And you're not going to hit 5% every week, but you can do it a lot.
And some weeks I even have a negative.
Yeah.
And that happens.
Yeah, because I think a lot of new traders...
I'm not beat myself up over that either.
Exactly.
And here's the analogy I give to people.
Yeah,
here's the analogy I give to people. I say, and I use Tom Brady because everybody knows him, right? When Tom Brady is in there and he's running down the field and then he throws an interception, does he go and sulk on the sidelines and just say, "No, coach, I don't want to go back in. I give up. This is too hard"? No. He threw the interception. All right, move on. Let's go back on. Let's get back after. Let's score a TD the next time. And that's the mentality you have to have. It's like, all right, I messed up here. Fine. What can I learn from it? Let's move forward.
Look what my boy Tony Romo, how many interceptions he threw. And he still wound up being an awesome quarterback.
Well, hold on. That's subjective.
Oh, man, I remember watching a game with him, and he blew out one of his lungs, and he finished it, and he still won the game. Came back to win with a blown lung.
Right.
Yeah.
So, yeah.
Legend.
Yeah. You asked it.
They should go back and just give him a Super Bowl. Sorry. I'll stop.
No.
He deserves it.
No. You asked pre-podcast, do you compare yourself to the S&P as a benchmark? So I say no. I compare my benchmark to what I've set myself for a goal for the year, my trading account. My investments accounts, I hope I beat all the S&P, the Dow, the hedge funds, and all of them. I hope that one doubles every year. It doesn't. It doesn't, but I do beat the S&P every year, guaranteed. I don't use it as a benchmark because I don't like using those as benchmarks. I've set a higher goal for myself. I expect better out of myself than that.
I still do, because that's what hedge funds and stuff and mutual funds, they measure themselves against the S&P 500. And to be honest with you...
Why they all get above 30% on average?
Huh? Oh, no.
Is that why all of them don't get above 30% on average? Because they all measure themselves by a lower trending thing. If you measure yourself by something higher, maybe you hit it. Maybe you fall short, but you just beat everybody else.
So here's the thing. When you're investing in a way that's going to beat the market, you cannot possibly, I don't think at least, be a hedge fund manager and do that. Because oftentimes you're investing in ways that your clientele is not going to like and that they will not understand.
100% agree with that statement.
So
100% agree with that statement.
The best they're going to do is be right on track with the S&P 500. And most of them aren't even going to do that. So, and then even if you go, and even if they are investing and doing the contrarian method, most of those aren't going to last either, because you're buying stocks that everybody's bearish on, and then your clientele is going to come and say, "Why the hell did you buy this stock? Everybody's telling you I should sell it," and then they're going to fire you. So, there's a lot of incentives that make it very hard for a hedge fund to beat the market. But
we're talking about individual retail investors right now.
Yeah. So I still, for me, I beat the S&P 500. Oftentimes, I'm just edging it out, just to be honest with you. I don't double my account yet. I'm not to your level of expertise on trading, but I'm at a very comfortable level of investing, and I still can pick out stocks that will hit that 3 to 5% in a week. I don't think I do it as much as you do.
You have it. You're smart enough to get that 5% a week. Everybody really is, but you did make a comment pre-podcast about a new beginner, a person in the first year.
Yes.
And that was the one part I actually did 100% agree with you on. That because someone in the first year, it's okay if you're just barely positive, profitable, barely, like 1%. I would take that as a win. Because I'll be honest with you guys, my first year, I lost 100% of all my money I invested.
So did I.
Every last dime. And this is before you could retail trade with options. All right. So I did it just with stocks, no options. Lost 100% of my money. That's how bad I was.
75% of retail investors do that. Think about like just some of like how far you've come since the first day you invested. I remember the first stock I bought was Apple, and I bought it with my Scottrade account. And I called Scottrade and asked them, I'm serious, but this is going to sound really stupid, and maybe I should edit it out of the show, but I was wondering when my stock certificate was going to show up in the mail. I thought I was still getting those.
Yeah, I had a Scottrade account as well, because that was the cheap account back. That was like the Robinhood of its day, $7 trades.
Buy $7, sell $7, and hey, back then, you couldn't get into the market with if you had less than $1,000. It made no sense for you to buy or sell stocks.
Yeah, because you had to cover $14 in trading fees.
Yep,
minimum. That was the minimum out there.
Yep. Okay, so we'll go on. Restoration Hardware is what I still call them, but they're RH now. They reported earnings last night. Earnings per share. They came in at $4.89. Expected was $4.07. Revenue came in at $860.8 million. Expected was $751.5 million. One thing that I felt was interesting about this, their expectation is to be net debt free by the end of the year.
That's crazy for a retail company to do that.
Yep. They also said, made a comment regarding the current environment. The rebound, their expectation is that this year is going to be very similar to the roaring 20s for consumers. So a lot of energy and a lot of buying.
Okay, all right, stop right there. All right, now I'm a bear. I'm a bear on this company, just because of that expectation as to that's the reason for why they say they're going to achieve greatness is because the economy is going to be the roaring 20s. I'm a bear.
That's what they think, though.
I say don't buy, sell this, short this stock, get out of it if you're in it. If that's their whole reason for why they're going up.
No, that's not their whole reason. Okay, they had consumer demand for their brand was, I don't have this number, it was above 100%. I think it was 109%. So lots of rebound for Restoration Hardware.
People on earth want their brand, then they're, No, I'm just kidding.
No, this is year over year. And then beyond that, they didn't really suffer last year during the COVID drop. And part of that is when you have a luxury brand, you have high-end customers, and the high-end customers, they may pause their spending during recessions, but they don't really lose their ability to spend. So these luxury brands, oftentimes, they come out okay.
All right, so furniture across the board. I'm not going to name names, and Brandon knows why. I still have a somewhat position in the industry, and I'm not going to name names for that reason. I don't make comments on this sector for that reason publicly. But furniture across the board all was successful. All the major companies did amazing last year. It was because people were stuck at home and they wanted to remodel their homes. Mm-hmm. Most of them, Brandon,
Yeah. Interesting takeaways here. Return on equity. The 5-year average for them on return on equity is 40.91%. Last year's return on equity was 116.74%. Income per employee is $61,280 per year. I just mentioned the return on equity, 5-year average, 40.91%. Their industry average is 16.02%. So that's a huge beat for Restoration Hardware there against their competitors. Here's return on equity, 116.74%. The industry is 11.07%. So more than 10 times the return on equity for Restoration Hardware versus their competitors. Gross margins, 46.53%, powered by the fact that they do not have seasonal products. I thought this was interesting. They don't have seasonal products. Therefore, they don't have the need to mark down as many products as their competitors do. You know, you have a situation where you come out with the fall colors, but when the fall's over, those are out of style, so you have to discontinue all the fall colors that didn't sell. They don't do that. Initially, when I was looking at this stock, I saw the price to earnings 61.4%, price to books at 33.27. I thought it was overvalued. I thought it was greatly overvalued. But then I looked at the 3-year earnings per share growth rates, 291.14%. And that's why I say this company's fairly valued. If you want to buy it, I'm okay with it. I'm not buying it because it's not undervalued, but I still think you're going to get a positive return here. Even at the $700 share. Neutral or what?
Neutral. You didn't sell me. You didn't sell me on buying it, but you sold me on not being a Jurassic Bear and chewing this up.
I love this company. I don't love the price that it's at, but I'm okay with it.
All right, fair enough. What else you got, man?
Craziest things I read on StockTwits this week. We want to go into this because I know you've got some.
I do have a few, so we're going to use this as our transition point. You do yours, I'll do mine, and we'll transition.
Alrighty. First one. I'm 19. I just quit my job. I'll start that over. I'm 19. I just quit my job where I made $1,000 a month. Now I spend $200 to $400 a day YOLOing. Odits. I have no idea what that person was trying to say there, but they put Odits. Please buy the effing dip tomorrow.
Alright, here you go. Ready?
Wait, okay, we'll alternate. Go ahead.
Turn that poop into wine.
Yeah. I'm for that.
That one.
Yeah.
Go ahead.
Drugs aren't bad if you do them right. I'll take your word for it, buddy.
I am more afraid of this Kenny G line. I have no idea.
No clue what it means.
There was no picture, nothing that followed that. It was just that.
Okay, here's one. What's the best trading book you've read? You are asking this on StockTwits. Do you think these people read? Pay attention. Go to Reddit.
Only way
that would be better.
It probably would be. Quote unquote, the only way I would sell is if I needed next month's rent money. Oh my goodness. Wow, alright.
There's so much to unpack in that statement.
Funny lines from StockTwits. There's the one for this week, guys. There's the ones for this week. Alright. I'm going to skip out on a couple of mine, but there's a number of things I do want to cover. I want to cover real quickly. I know this one, you have like 1 or 2 lines you want to mention about it, so I'm going to jump into my stats here, and let me read off a few stats about inflation. All right? Mm-hmm. CPI number came out today. Consumer Price Index, or CPI, was jumped 5% this month. Now, the Fed Reserve meets on June 15th and 16th. I want to know, based off this jump, will they start to cut back on their QE or their buy-in? Yes or no? What do you think, Brandon?
No.
All right, because they're currently buying $120 billion a month in treasuries and mortgage securities. So if you think the housing market is booming because they're giving loans out right and left, yes, it's because the government's just buying them.
Mm-hmm.
It's not because the banks actually believe in the consumers.
And that's why treasury rates are down.
Yep.
I mean, there's nobody in their right mind buying a 10-year yield right now at 1.49%. It makes no sense when you just had the CPI jump to 5% last month. That's brainless.
Exactly. And they started QE back up after 2007, 2008. What happened during that time? Because they wanted to create liquidity and keep interest rates low. That was their 2 goals that they had. Create liquidity and keep interest rates low to get the economy speed again, after that drastic event, right? Then they accomplished that and they never quit it.
Now,
they never quit.
I will say this: there's only two reasons that you would be buying a treasury right now. That's if you expect the rates to continue to drop and then you can trade it and sell it. You're not holding it for long term. Or, this is kind of a scary thought, if you think that 1.5% is the safest place for you to be.
That's less than inflation, though.
Oh, it's less than inflation, but
you're gonna end up losing money, man.
Yep.
That cost of bread is gonna put you homeless. Your bread, your milk, your coffee, your gas. It's just going to make you homeless. You've got to. I don't know anybody. Actually, all right. Let me rephrase this whole statement. I don't know a lot of people that work for me that get a 5% or more raise a year, and which is unfortunate. I don't have control over giving out those raises there.
Right.
And it's unfortunate because they're not keeping up with inflation right now.
So how do you beat inflation?
They're getting poorer and poorer. High inflation hurts the middle class and the lower class. So
it benefits the banks.
When you print out money, when you just printing it out to pay for all these programs, you're actually making the poorer and the middle class poor.
Yeah, because the value of the money drops. And what's funny is the rich people get the money first. So the top 1% that everybody complains about, they're the first ones to get this newly minted money, so they get to spend it while it's still valuable. Then it reaches your hands. By the time it reaches your hands, it's dropped. So you may have the same, single dollar bill that a rich guy has if you got a dollar bill, but, those banks and the CEOs of the banks and people that get the money first, those people, they have more power with their money than you do.
They've already turned that dollar into $1.10 by the time you get your dollar. So they're doing better.
Yep, it sucks.
It frustrates me, this whole inflation thing. Then now with that CPI number coming out the way it was, the Fed was playing defense with all their quotes that they were giving out there saying, we're not worried. This is just going to be, what was the word? Temporary. I couldn't remember the exact word they used, temporary. It's not going to be a permanent inflation rise. But when you see a 5% number, you haven't seen a number like that since before 1992.
Right.
It's been a long time. I mean, you might even have to go back, if it starts getting higher, you might have to go back to the 70s here. And now you have the hyperinflation that everybody was worried about, and that's going to put us into a recession.
Yep. I said at the beginning of the year on Facebook back in January, I think it was my New Year's post because I'm a dork, and I said that everybody's going to learn a lot about stagflation this year.
And sure enough, we have.
Yeah. I mean, even if it doesn't happen, I knew everybody's going to be afraid of it. So, I mean, one of the things, how do you beat inflation? Like what you talked about, I know about your gold medallions and things like that, the gold coins. There are other ways that you could do it. So, like, during the housing crash, one of the things that I did is I went out and I bought a bunch of antiques at antique malls and yard sales and things like that, and then certain collectibles too that are old and that I think will gain value over time. Those things tend to beat inflation. Art, you can do art, so you can go outside of the stock market with it. You can go outside of gold even, and when you have a recession and deflation, which precedes inflation, obviously, then you go and you buy these just like you would in the stock market for great deals, and then they'll go up in value as inflation rises.
That's definitely one way to do it.
A little outside of the box.
You can also just invest in commodity companies.
Yeah, you could do that. And you can do a commodity company. You could do it all. Just stay away.
Gold, man.
Just stay. Everybody remembers the great Beanie Baby bubble of 2000.
Yes. I do. I don't know if everybody does, Brandon, but I do.
Everybody, all the girls listening to this, all the 2 girls that listen to our podcast might still have a whole closet full of worthless Beanie Babies now. It is interesting to me though too, because there are bubbles and there's bubbles in every market. It's not just the stock market that it happens to. It happens everywhere.
Yeah. You're right. There are bubbles all over the place, man.
In the 90s, it was baseball cards.
Couple things I want to talk about. couple other things I want to talk about. Now that I got my inflation burst out of me, that made me feel a lot better. I wanted to talk about SBCE. Last time I was on the show 2 weeks ago, I called it. It was at 22. I said, go ahead and buy this. This is going to go up. There's definitely a reopening trade. It's at, last time I checked, $35.49. If you haven't sold already and taken your profit, please sell. Sell. Take your profit. Don't be greedy, guys. Make money. Bulls make money. Pigs get slaughtered. Don't be greedy. Take your money and be happy. SBCE is Virgin Galactic, if you don't know. We're talking about Blue Origins and Bezos and Virgin Galactic and SpaceX and all these corporations taking the lead in the space front. I actually love that. I want the private companies to really take the lead and be able to jump forward. NASA laid the groundwork for all these companies to be able to do that. Thank you, NASA. We would not be where we are if it wasn't for them, what they did during the 50s and 60s. Fortunately, we are where we're at now, and the private companies can take that mantle over and drive us into the next era here, and I appreciate that. So please keep going, guys. I would support you guys as long as I can. Another one I want to talk about is RIOT, R-I-O-T. This is a blockchain, a Bitcoin mining one. It closed today at $31 flat. I know I keep talking about this one was to keep lowering your cost basis as it went down. I would not buy it right now at 31. Just because all the institutional companies are not buying Bitcoin at the moment. They are pausing. They're not selling their Bitcoin, but they're not buying. They're in a neutral hold state right now. And so I would be in a neutral hold state as far as day trading or swing trading RIOT right now. I would wait and see how this plays out and what goes on with Bitcoin before I would make a move there. A little too much volatility with the institutional investors not buying in.
We're still bullish on Bitcoin, though, right? You are?
Huh?
You're still bullish on Bitcoin?
I'm bullish. Now, here again, I say this caveat every time when this comes up. I am bullish on Bitcoin for the long term. I'm bullish on Bitcoin for the 5-year plus term. Yes, I think it's a great investment to hold in your long-term holdings. It's not something that you're going to day trade and or swing trade and you're going to make 5-10% this month off of. No.
There's not a crypto ETF, is there? Why isn't there?
There is.
But
there
it's
is.
but
the twins.
So you could go. Can you go and buy? You can go and buy like an ETF that holds Bitcoin and maybe even like Ether.
The Winklevoss, yeah, the Winklevoss have something.
Okay,
check that out, dude.
Okay.
In fact, guys, listeners, next time I'll have that ready and available for you. The ETFs, the Winklevoss, I believe, have a couple of those going on.
Cool.
They've done very, very well because of all the crypto. Of course, they were touting Bitcoin at less than 1,000, and they were putting their family's fortune into it at that time. So they're still doing very well.
Nice.
They haven't. They're not hurting. All right. I have two more things I want to run through. I don't want to rush them, but we can run through them quickly. One of them was Clover Health Investments, CLOV. This was one of the Wall Street bets pumps. It hit its high at 28.85, right? This came onto the news. Wall Street bets was all over the market saying, "Hey, buy this. Let's pump this up. Let's get this going." They pumped it all the way up. Today it closed at 14.34. So everybody that got in and saw that it jumped immediately that first day up to like 20 and bought at 21, 22, saying, "Oh, this is going to go to 100. I'm going to make tons of money." Yes, they're now down losing money right now at 14.34. This is the kind of mentality I keep trying to warn people of. Don't follow the crowd. Like, if you see something jumping up from $10 to $20 and you have no idea the reasoning behind it, you don't understand the movement, then don't invest. Don't invest. Do you agree, Brandon?
No, I absolutely agree. I saw a stock last night that I texted you about, and it appeared to be such a great value. This was actually kind of the opposite situation, where the price was so low on it that I couldn't believe it. It was trading at a PE of 2, and price to book was like 0.87. I was like, this is unbelievable. And revenue last year was amazing. And then I saw they had sky high long-term debt, and their debt to equity ratio was 2.27, I think, or 2.28 or somewhere around there. And I was like, well, that's the reason, So if you don't know why, you shouldn't buy it. And in that case, I dug until I found the reason why it was trading for such a value, and I decided not to do it. But regardless, just to come back to Dave's point here, even on the opposite end, if something's jumping, you don't just buy it because it's jumping. You need to know the reason why. Otherwise, you're just going to be completely blind in the trade and have no idea what to do once you're actually in it.
Right, exactly. Do your research, make sure you know what you're doing. Stick to only the stocks you feel comfortable trading. Stay with what works. Stick with what's comfortable, guys. This is how you hit 5% a week. This is it. I should have started a new company called 5% a week, because that is what I say all the time. Like, just go for 5% a week. Don't go for 20 or 100. Just 5%, guys. It's not hard.
Now, see, with my trades, I aim in between 3 and 5%. Most of the time I hit it. Sometimes I don't. Most of the times I do. But I do find long-term value, and I buy those things because for me, they just seem to be more not guaranteed, but more sure. So I always have investments on one end, and then on the other side, sorry about that. On the other side, I have trades. So I kind of split my money up. Now, I know some people actually do it with separate accounts, but that drives me nuts. I can't do that. I keep it all on one account.
Separate accounts keeps it better because of the goals I have for my swing trade, day trading. It's so high and hard versus my goals for my investments. It's more longer term. I don't need to hit that 5% every single week in, week out.
It probably is better strategically to do it that way, but it breaks my brain at the end of the year when I'm trying to do the math and I have separate accounts.
That's why you hire a tax attorney and you don't mess with it.
Yeah, that's true.
All right, guys. Here's my call for the week. I really wanted to call this one. This one was actually given to me by a buddy of mine. He's a Kentuckian, so, he had to read this one with his shoes off in order to do the math. But that's a joke if no one knew. Thank you for humoring me with a laugh there. He sent this one out to me, and I actually agree with it. I think it's a good call. I did some research into it. BLNK, Blink Charging. With all the EV vehicles that are going to be pumping out in the next few years, Porsche keeps upping their sales of their EV vehicles. You have Tesla coming out. You have all the other higher-end EV vehicles, and you have the lower-end EV vehicles for the everyday person, such as, i.e., the Chevy Volt or one of these other ones. Charging stations are going to start popping up everywhere. Guess who's the biggest manufacturer that I know of that you can publicly trade? Blink Charging. BLNK. Blink Charging, guys. This one's going to continue to move. It's a good long-term investment. It's a good swing trade. It's a good both. I'm a buyer.
Do you think they'll get an infrastructure contract?
They may on this new infrastructure bill. That's also another reason why I said swing trading it looks good for this one. I'm a buyer, so I'm pulling up my stock account right now, showing Brandon. We're calling this at $38.50. That's the buy price. $38.50. We're going to see this one go higher. Hopefully by next week, I'll be able to come on here and say, hey, it hit 43. I hope you sold, took your 5%. Or if you're a long-term buyer, hold on until it goes over 100. It may not. But I believe they're going to have a lot of contracts coming soon.
Nice.
Final thoughts, Brandon. Go ahead. Final thoughts.
I don't have any. No, just don't ask stock twits what books to read because they're not reading any over there.
Those guys don't read books
I don't think
at all. I have no idea. Those guys get on there, and some of the comments I read, Brandon, I'm just like shaking my head, like, wow,
what is happening here?
Wow, this is why you're losing money. This is why you're losing money. All right, guys. Happy Thursday. I hope we've been entertaining, educational, uplifting, because we want everyone to make money. Have a good night.
Have a good night.